In the previous part of the series, we covered borrowing and lending in stablecoins, which are used to maintain a stable value of tokens on exchanges. This part will look at three more pillars of decentralized finance, or DeFi: decentralized exchanges, or DEXs, insurance, and margin trading. As decentralized finance continues to grow, it has the potential to disrupt current models and drive positive social change through economic inclusion. We'll conclude with some observations about the future of decentralized finance and how it might shape crypto markets in the coming years. Before we move on to the next pillars of decentralized finance, let us first expand our understanding of borrowing and lending. I know there are still questions in your mind about this certain topic that needs to be answered. You might be wondering, why would I need to take a loan if I already have the money? You might be thinking of money in United States dollars. For example, if you had 10 Ethereum worth $150, you were unwilling to sell them because you deeply believe in the Ethereum project. So you borrowed $700 worth of Tether as collateral and did some arbitrage with it. You made a lot of money in your first few trades, but you lost most of it on your last trade. Now you need to pay back your debt. For example, you used up $750 of your credit line to pay back the original $700 you owe on your Bitcoin position, and you got lucky because you only bought for a price that resulted in a net profit of $50. But then after a few months, Ethereum exploded and reached $200 each, so now you have 10 Ethereum at $200 each. Now you have $2,000 and the $50 you made trading. In other words, if you own Ethereum and don't want to sell it, but want to be able to use its value, you can take out a loan on it with the hope that it will be worth more whenever you cash it out. If you had previously traded and lost some money, you gained some money and then you lost some money. But then you might find yourself with a $650 Tether. In that case, you will have two options. Option A will repay the full loan with an additional $50. Option B is the more riskier route, as it only refunds $650 and leaves you with 10 Ether that might become worth more. This may seem overwhelming, but there is a second type of loan in cryptocurrency, a flash loan, which lasts for only 10 seconds. If you buy Ethereum on Coinbase for $10 and sell it on Gemini for $15, you can make $5. We call this type of loan a flash loan, where you borrow money with no collateral and no down payment. You wrote a very high interest loan to borrow $15 million. You told it to buy Ethereum for $15 and then immediately sell it for $20. At that point, you'll give back the $15 million. Just a quick contract, worth a measly 10 seconds. You essentially earned $1 million minus the expenses for borrowing the money for a very short time. The fee is small because the lender knew that you would repay the money that you borrowed and that it was only for a short time. This is a more advanced investment strategy and should not be attempted in tandem with basic arbitrage or more traditional forms of investing. Now let's move on to the third pillar of decentralized finance, decentralized exchanges. For example, if you're traveling from the United States to Japan, you will need to exchange your money for the other country's currency. As for Japan, their currency is the yen, whereas over here in the United States, it's the dollar. So as a result, he went to a currency exchange booth and traded out his US dollars for euros. For example, the exchange fee was about 15%, so you lost 15% of your money immediately because that's what currency traders do. Tourists may not be familiar with the details of the financial system, but they need to spend local currency, so they take advantage of other people instead of decentralizing finance by letting someone else act as the middleman. We have a peer-to-peer exchange where you can trade your coins and tokens for others of the same or similar type. As such, fees for these kinds of exchanges are typically very small, like less than 0.5%, which greatly benefits anyone who trades cryptocurrency regularly. For popular decentralized exchanges or DEXs, it works because traders pool their money together. So let's say you were an investor. That fee I mentioned earlier goes to you. Bitcoin can't be censored because it's encrypted and hidden from the government. All of the fees and the percentages are coded, and then they won't change unless it's coded to, so they can't go out of control and be 15%. Decentralized exchanges provide new tokens and coins to the global world. One such example is the cryptocurrency exchange Coinbase, which is first centralized to go public. While they only allow you to buy and sell 32 cryptocurrencies right now, they are regulated by the government and have to abide by certain regulations. Many coins cannot be traded at this moment because Coinbase has to thoroughly analyze each coin before adding it to their exchange, which is called Uniswap. Literally has hundreds of tokens that you can trade, which means they are not regulated by anyone. This is what's referred to as decentralized system. With $1 trillion of cash sitting in these liquidity pools, traders can continue to trade. Yet nobody can control this money. It's merely following a program that someone else wrote. Actually, the only ones who can get their money out of the fund are the investors. But if they did that, the interest rates would rise, and new investors would be encouraged to put their money in. As I mentioned earlier, you can't change the code. This is why it's referred to as immutable. So in the crypto space, we like to say that the code is the law. It's free from regulation, and you can examine the code in the network yourself, which doesn't change. One of the leading cryptocurrency exchanges is Uniswap on the Ethereum network. This platform has billions of dollars in its pool. Similarly, PancakeSwap on the Binance Smart Chain network has a few $1 billion in liquidity. Before we go any further, feel free to click on the like button at the bottom of the screen and then consider subscribing to our channel to show us your appreciation. Now, fourth on the list is insurance. Insurance is really easy to understand. For example, when you purchased a Tesla, you also bought a car insurance plan at $100 a month. One day, while the autopilot was activated, another car malfunctions and creates a power glitch which malfunctions the autopilot, and you veer off course and wind up in a ditch. You could get out unhurt, but the car wasn't so lucky. But luckily, because you paid for insurance, the insurance company will pay you the Tesla's worth, so you can go and buy a new one. These insurance companies use statistics to predict how many drivers will crash their cars, and then use this data to predict how much they would have to pay each year to determine the monthly price of the insurance, which is also called the premium. But with decentralized finance, the insurance company can be coded. Like an insurance company can make a profit, people who lend liquidity to any decentralized finance platform may be rewarded with an interest rate. And finally, number 5 is margin trading. I hope that clears up what margin trading is for anyone not aware. Now I will walk you through the traditional margin trading process and then show you how margin trading works in the decentralized world. Let's say you want to buy 100 shares of Apple. That would currently cost you $100. Margin is when your stock may automatically be sold when the stock's value goes below your loan value. So to buy a $100 stock, you would need a $100 loan. The bank will agree to provide you with $100 if you give them a $20 down payment and an annual interest fee of 5%. However, there are two possibilities that could happen. When the stock goes from $100 to $150, you paper trade. So you sell the stock and get $150. You only have to pay back $80 of your loan because the bank has already taken your original $20 deposit. You still get to keep the remaining $70, which is a profit of $70. Basically, you made $70 on a $20 investment. The value of the stock went up 50%, but you made more than triple the profit. This is the power of investing when you anticipate an item will appreciate the value to accumulate more money for yourself. Now let's see how things change. In this scenario, let's assume the stock's worth is $50. Basically, if the share of stock isn't valuable enough to cover the loan's interest, you'll need to sell it and try to break even as it drops in value. The stock starts at $100, and the rate drops to $90, $85. When the stock reached $80, the bank insists that you sell it because you had taken out a loan from them, which you need to pay back with the $80 that the stock sold for, adding up the $80 you made by selling the stock, the $20 you put down to initiate the purchase, and the $100 the bank gave you in the first place. You're in the black. You've made good on your loan to the bank and paid it back, but you haven't made any profit. In addition, you also lost the original $20 you contributed as a down payment. When you trade on margin in a centralized financial institution, you need to show identification, have a specific minimum, and have much higher fees. With decentralized finance, any global citizen can partake in margin trading and have significantly lower fees. To sum up this video, we've looked at the 5 big pillars of decentralized finance: stablecoins, lending and borrowing, decentralized exchanges, insurance, and margin trading. Thank you so much for watching. Hit that like button to support our efforts, and please subscribe for more like this one. And if you enjoy these videos, feel free to share them with friends. Thank you so much, and we'll see you next time.